So before we took a break, we talked about the first two of three different ways taxes can be structured. Now it's time to move on to the third one. The third one is what we use for the U.S. federal income tax, and that's what we call a progressive tax. And that doesn't have anything to do with politics. It has to do with how the tax rate moves. The tax rate goes up in different brackets as the amounts go up, and I'm going to illustrate what that means here in just a second. As of right now, the United States tax system has 7 different brackets, and that'll be explained in a second. Those brackets, the rates and the ranges, are adjusted every year to match the economy. Let me sort of give you an example of a fictitious tax bracket. These are not the way they're actually set up. But what this says, what you're looking at on the screen, is that if you're talking about your income for the year, the first $0 to $10,000 of your income would be taxed at 10%. In this example, anything from $10,001 up to $30,000 would be taxed at 20%. 25% for $30,000 to $60,000, 30% to $60,000 to $90,000. So what exactly does that mean? Well, let's look at some examples. Let's say that we have someone who has $40,000 in taxable earnings. According to the tax brackets that we're using here for this example, that means that the first $10,000 of that $40,000 is going to be taxed at 10% rate. So there'll be $1,000 due. The next $20,000, which goes from their $10,001 up to $30,000, is going to be at 20%. So there'll be $4,000 due for that chunk of their earnings. Now, so far we've accounted for the first $10,000 and the second $20,000. So we've accounted for $30,000 of the $40,000 in taxable earnings. That means there's only $10,000 left in the 25% bracket. So that $10,000 times 25% means that the taxes that are going to be due would be $2,500. So in our example, our imaginary example here, on $40,000 of taxable earnings, there's going to be $7,500 due in taxes. Another example is instead of $40,000 in taxable earnings, we're going to have $80,000. So the tax is going to be on the same on the first bracket because it's the first $10,000. It's also going to be the same on the second bracket. When we get to the third bracket, in our first example, there was only $10,000 left. But in this example, there's a full $30,000 still to work with here. At 25% means that the taxes on that bracket of income is going to be $7,500. And then finally, we've got $20,000 that we still need to tax that'll fall in the top tax bracket that we're looking at right now. So that would be 30% or $6,000. So for this taxpayer who has $80,000 in taxable earnings, their tax due is going to be $18,500. I'm going to move all this up on the screen a little bit and relabel those so you can see what they are. When we talk about tax rates, we usually talk about 3 different ways to look at them, 3 different ways that we can compare them. The first one is what we call the marginal tax rate. And that's really kind of simple. It's whatever the tax rate was on the highest bracket that we used, on the last dollar that we taxed. So in our first example, our highest bracket that we used was the 25% bracket. So they have a 25% marginal tax rate. For the other example, the highest bracket we used was 30%. So they have a 30% marginal tax rate. That's the marginal tax rate. Let's now talk about the average tax rate. What we do on average tax rate is we take the actual amount of taxes and divide them by the taxable income. So for the first example, we would take $7,500 in taxes divided by $40,000 of taxable income, and that gives us an 18.75% average tax rate. For the other example, we would take the $18,500 in taxes divided by the $80,000 in taxable income, and that would give us a 23.1% average tax rate. So we've talked about marginal tax rate. We've talked about average tax rate. The third one is the effective tax rate. And the way we work through that is we take that same tax amount, but instead of dividing it by the taxable amount, we divide it by all the income that's earned. What does that mean? I'm going to explain it to you in just a second. We'll come back to this screen in just a second. Let me jump over to something real quick so that I can explain to you the difference between all of the income that comes in and just the part that we consider taxable. And that sort of falls into what we call how much. How much of the total earnings is taxable? We're going to dig into this pretty hard in the next chapter in depth, but for right now I want to give you just enough understanding that you can work through what you need to in Chapter 1. Here's the way we look at this. All of the income that you have earned in the entire year is added up. And then the government says, wait a second, there could be some parts of this that we're not going to make you pay taxes on at all. I'm going to explain what that is in the future chapters. For right now, in Chapter 1 in your book, what you'll get is you'll just get some information that says there's X amount of dollars and exclusions that you need to deduct from the total earnings. When you subtract that, we end up with what we call gross income. No, it's not icky gross income. It's the large total amount of your total income minus those exclusions. From here, we take gross income and we actually deduct some deductions from it. And those deductions get divided into two different categories. Once again, we'll go into this harder in the next chapter. But for right now, here's what you need to know. The first set of deductions that we deduct from gross income is what we call deductions for adjusted gross income. So we're deducting some things out to help us figure out what the adjusted gross income is. Once we have the adjusted gross income, which we abbreviate as AGI, and let me tell you right now, we're going to use this phrase over and over and over again in this course. Adjusted gross income is a big thing that we talk about a lot. So we take gross income, we deduct out the adjustments that help us arrive at the adjusted gross income. Once we have that, the second set of deductions that we take out is what we call the deductions from adjusted gross income. So the first set of deductions are things that we're deducting out so that we can get adjusted gross income. The second set of deductions are what we're taking out from that adjusted income. When we do that, when we take both of those sets of deductions out, we end up with what we call taxable income. So that's the difference between taxable income and all of your income. All of your income, I've got highlighted in blue. Taxable income, I've got highlighted in orange. Let's go back to that other screen where we were at just a minute ago. If you'll remember, I said we're going to be coming up on this, and now I'm going to explain it. Remember where we were. We had taxable income for our first example of $40,000 and for our second example of $80,000. That's how we ended up with the average tax rate. We took that taxable income and it was divided into the amount of tax due. For the effective tax rate, we do the exact same thing, except instead of using the taxable amount, we use all of the earned income, not just the taxable part. So when we say all earned income, that's before all the deductions. Okay, believe it or not, that's it for Chapter 1. You're ready to wrap up here. Why don't you go ahead and finish this lesson, work through your homework, post your original post on the discussion questions. When you're ready, take your quiz, then follow that up no later than Sunday with the responses. That's it. You know where I'm at if you have questions. Make sure and reach out and let me know.